Markets.com company profile of Wells Fargo and Company. Founded in 1852 by Henry Wells and William G. Fargo, Wells Fargo's headquarters are located in San Francisco, California. Approximately 159,000 employees work for the company, which operates in the U.S. and worldwide. Currently, Wells Fargo's market cap is $111 billion. The company is run under three segments. Those are community banking, wholesale banking, and Fargo Financial. Dick Kovacevic is the chairman, and John Stumpf is the president and CEO. Wells Fargo is listed on the New York Stock Exchange, where it is traded on the S&P 500 index. Moving on to the company's financials for 2007, Wells Fargo reported revenues of $53.5 billion and net earnings over $8 billion. The balance sheet indicates that assets were over $574 billion, liabilities were under $528 billion, and shareholders' equities were under $48 billion. On December 31, 2007, the stock was priced at $30.19. As of November 5, 2008, the stock closed at $35.11. Almost $4 billion in dividends was paid out to the shareholders of the company in 2007. Taking a look now at operations, Wells Fargo offers insurance, payday advance, mortgages, consumer finance, and corporate and investment banking. Bank of America and U.S. Bancorp are its biggest competitors. Wells Fargo's original vision for growth involved increasing the financial services they offered their checkings and savings account customers. They did so through growing wealth management, insurance, and business banking. Now, however, their growth involves acquisitions of smaller banks along with the successful integration of Wachovia into their company. Meanwhile, Wells Fargo is one of the hardest companies to forecast since it has a lot of questions surrounding it. First, their books include a lot of mortgages from California, but they have not taken as much write-downs as other companies with exposure to that market, while their loan provisions on the books are also lower when compared to its peers. Two possibilities could explain this. One is that they kept mortgage standards high, and two is that they have yet to start incurring losses. Another problem is the recent purchase of Wachovia. There are some analysts that believe that this purchase was good because Wachovia was an undervalued asset, while others believe that Wells, after being a very conservative bank for a very long time, is now increasing its risk appetite. The first assumption suggests that Wells Fargo should be trading at a higher multiple, when the latter means that the risk premium on the stock must increase. From an operations perspective, however, the acquisition makes sense. The bank's branches had very little overlap since Wells was mostly a West Coast bank and Wachovia an East Coast bank. Now Wells Fargo will be a national bank on the scale of competitor Bank of America. With that said, if the integration of Wachovia goes smoothly and Wells manages to get through this economic rough patch unscathed, it will thrive as a stronger bank. And that wraps up this Markets.com company profile of Wells Fargo. I'm Luisana Swegard. See you next time.